Hey everyone, this is Chad Shimabukuro with Keller Williams Honolulu. Thank you for joining me today. I'm going to be talking about mortgages, Mortgage 101 specifically for real estate agents. If you are not an agent, it's kind of entry-level stuff for the most part, but I do find in what I do and in speaking with agents every day, there's a lack of information of what things are like pre-approvals versus pre-qualifications and the underwriting process and so forth. So my background is I've been in real estate for 21 years. I have 18 licenses, both in mortgage as well as real estate broker licenses. Currently, I am the president and principal broker of Keller Williams Honolulu, and it is an honor and a privilege to be able to teach some of these kind of classes for our agents. So I'm broadcasting right now on 4, 5, 6, 7, I think 8 different channels, Facebook, YouTube, and some other ones. So if you have questions, feel free to type them in. I'll try to keep an eye out for comments, and I'll try to answer some questions as we go along. So let me share my screen and we will get started. So again, this is Mortgage 101 for agents. What is the purpose of doing this particular class is to get a better understanding of common mortgage language, some of the terminology, the differences between a lender, bank, credit union, mortgage broker, etc., how loans are processed and underwritten, ordering payoffs, what per diem means, paying in arrears, and distressed properties, all those kind of things. So we'll go over some of these things. So what are some commonly used terms? DTI is debt to income ratio. This is basically the amount of debt that a borrower or borrowers have in relation to the income that they have, and it's a required ratio that all lenders will examine to see if someone qualifies and they can afford to have that certain mortgage. In 2009, and during the mortgage fallout, there were stated income loans. There was no income, no asset loans. Some lenders rarely paid attention to what the actual income was versus the debts. So this is a number that is extremely important to, as a qualifier, to make sure that someone in fact even qualifies to have a mortgage. So it's super important. LTV stands for loan to value. Loan to value is the loan amount by the value of the property as a percentage. So for instance, if you're putting down 20% as a down payment and you intend on getting one loan, a 30-year fixed loan, you'd be at 80% LTV or 80% loan to value. And CLTV is if you have a second mortgage on there as well. So if you put down 10% and you have a 10% equity line or HELOC and an 80% first mortgage, you would have an 80-10-10 or 90% combined loan to value. So it's just how it's structured and how lenders look at it. And the higher that loan amount or LTV, the higher the CLTV, the greater the risk, and so therefore your interest rate could be a little bit higher. PMI is private mortgage insurance. Private mortgage insurance is something that is needed or a necessity to have if you're financing more than 80%. It also goes hand in hand with some other types of mortgages, such as an FHA loan, and we can talk about that as well. MIP is mortgage insurance premium. There are some loans that have this built into it. An ARM is an adjustable rate mortgage. You don't see a ton of these today. They still exist, and there is no such thing. Some people have asked me before, isn't an ARM like is that a bad loan? There is no bad loans. There's no such thing as a bad loan. There's the wrong type of loan for the wrong type of buyer or borrower or wrong type of use. But loans serve a specific purpose. So if you have a property, let's say that you're an investor and you have a property that you only intend on keeping for a short period of time, an ARM might make perfect sense. The downside with that ARM is it's only fixed for a certain number of years. It could be fixed for 3, 5, 7, 10 years, and then it becomes adjustable to the index that ARM is tied to. So it depends. Now, if you are planning on occupying the property, let's say you're a first-time home buyer, and you don't want risk, you want some stability, an ARM's probably not for you, right? Because as soon as that fixed rate period comes to an end, it becomes adjustable afterwards. So might not be the best type of loan for that situation. Or if you're military, or your client is military and they're coming in and they know that they're going to be here for a short period of time, but So initially you might say an ARM might be good. If they're only going to be here for 3 or 4 years, maybe I'll put them in a 5-year ARM. The problem with that is if interest rates go up too high afterwards, after that fixed period ends, now they're going to be subject to a fully adjustable loan, depending again on the index that it's tied to, after they PCS or relocate to another duty station. So you can put someone in a precarious position by not understanding what type of loan they should go in. By far and away, the safest loan always is a fixed rate mortgage, like a 30-year fixed. Distressed property is a property that is for sale by an owner that might be in economic duress. And economic duress would be things like bankruptcy sale, court sale, probate sale, short sale, foreclosure. These kind of things are in the pile that we would refer to as distressed properties. What is the most commonly used mortgages? So there's tons of loans out there, tons of mortgages, some specifics in a bit as well, but by far and away, the vast majority of the ones that are used most often is conventional. Conventional is the same as conforming. I'm sure that you guys have heard that term before. You probably have heard of the term Fannie Mae and Freddie Mac. Those two entities are quasi-government insurance companies that insure some or most of that loan, so that, you know, it's in essence, it standardizes the process and it creates the same kind of guidelines unique across the board, which is good. Back in the day, before Fannie Mae, Freddie Mac, before some of these standardized guidelines even came about, you would go into like a savings and loan and you would kind of pitch your case to the loan officer as to why they should loan you money. And the rate of which you would pay, the terms of the loan, all the things that go along with it would differ and vary from bank to bank. So there was no uniformity, there was no standardization. And with Fannie Mae, Freddie Mac, at least ensuring this, they also created standard guidelines, which has been super helpful. So a lot of times people have the misunderstanding that if you go from bank to bank to bank, you're going to get a different answer. And there could be a reason for that, and I'll explain some of that as we go along here too. But generally speaking, conforming. So in that is conforming. There's also non-conforming, which could fall out of that bucket, but there's also jumbo, conforming jumbo. Adjustable rates fall into there as well. Fixed rates, 15 and 30-year fixed. There's also interest only too. Obviously, for those who qualify for it, whether you're active duty and you qualify, or whether you're retired military and you qualify, generally speaking, those are 15 and 30-year fixed, but for the most part, by a vast majority is 30-year fixed. There's FHA, there's USDA. VA, FHA, USDA is something that we refer to as Govy or government loans because they are all backed by some sort of government entity or administration within the government. FHA is very common and kind of, I wouldn't say mismarketed, but it's very much marketed as a first-time homebuyer loan. It really isn't first-time homebuyers per se. I mean, you could have owned homes before and still qualify for an FHA loan. The reason why they group that together, USDA and FHA, as first-time homebuyer loans, is primarily because of minimal down payment. USDA doesn't have any down payment whatsoever, as we'll see on the next slide here too. But that as well as FHA is 3.5% down. So it is a phenomenal loan program if you don't have equity or don't have a lot of down payment. Conventional, you can have as little as 3% down, so long as you have good FICO scores and you qualify for it. So it might require PMI or private mortgage insurance, as we mentioned before. In many cases, if you have good enough credit, you can split that loan up into two, having a first and a second. VA, there's no down payment. There is a funding fee depending on if you've used it before. If you're disabled, veteran, they waive that depending on your level of disability. Limited entitlement, that simply means that if you're in the military for 20 years and you PCS from area to area to area every 4 years, you cannot buy or use your VA loan to buy in every single state without freeing up the entitlement used to purchase previously. It's not one active loan at a time. It goes by county limit, and every county, as you know, has a different limit. We are currently, specifically Honolulu, has one of the higher county limits in the country. So, you know, versus as an example, throw this out like Texas. In some parts of Texas, it might have lower county limits. So if you've purchased a home using a VA loan in Texas and then moved to another county in another state, you may qualify to have another VA loan. So you have 2 VA loans going at the same time, that's fine. Whereas if you purchase in a high county limit, and then you move to a low county limit, you may not have as much entitlement, if any, available to make that secondary purchase. So the workaround to that is you can always refinance that VA property out of a VA loan, like into a conventional loan, and that would free it up. You can obviously sell the property. The goal, depending on your own, real estate goals, though, depends on what you're trying to do. Specific, like me, for instance, I would like to own as many properties as I can. So I'm not really in the market to sell property, but everyone's case is different. So if you can pick up and purchase multiple properties, if you're in the military specifically, and build your wealth by keeping and maintaining properties and turning it into rental properties, that really is your retirement in the future. That'll create some passive income for you in the future. So it depends, again, specifically on what you're trying to do. Moving over to FHA and USDA. USDA is 0% down, but it is area specific. So USDA is specifically made for rural areas. Now, specifically talking about Oahu, when people think of a rural area, they probably think like maybe Makaha or maybe North Shore or Ula or some things that are kind of on the outskirts. Believe it or not, there are a lot of areas that qualify for USDA that you wouldn't necessarily think. Like there's Waianae qualifies for it, Eba Beach qualifies, Waipahu qualifies for it, as well as North Shore and some other parts. But town, in town, absolutely does not qualify for it. So first thing is you've got to make sure that the area that your client, or if you are the buyer that you're looking into, has to qualify specifically for the area that you're looking to purchase. The other thing that is very unique is you cannot overqualify. So I'll give you this example. Let's say that you want a conventional loan and you make great income. Let's say you make $1 million a year and you're only looking to get a loan to purchase something at $500,000. Let's say credit score wise, no problem. Loan, debt to income ratio, all that stuff is not a problem at all. You make a ton of money. You get great, unbelievable income. You can overqualify, not an issue at all. That doesn't derail the loan or slow it down or disqualify you in any way. USDA is unique in that you have to fit this sweet spot. You can't overqualify. You have to make enough to qualify, but you can't make too much so that you overqualify as well. And so there's income parameters that are built into that. Is 3.5% down. Yes, you can put more money down in any of those cases. VA, FHA, USDA, you can put money down if you want to, and that would just simply lower your monthly payment. But if you're using that loan in the spirit of how that loan is created, then it's going to be 0% for VA and 0% for USDA as a down payment, and 3.5% for FHA. FHA also has a rehab loan, and in my lifetime of being in this industry for 21 years, I think maybe I've done just a handful of FHA rehab loans. Because it exists, it doesn't mean that it's a good idea. It's very tricky. That allows you basically to buy a property that needs some work, and then you get a little bit of a cushion of money that you can use to rehabilitate or renovate that. It's tricky, it is difficult, it is not for the faint of heart. If you are a first-time home buyer or you have a client that's a first-time home buyer, probably not recommend using that loan. This I found interesting. I love numbers. I love statistics, specifically talking about Honolulu. So those of you that are watching or tuned in outside of Honolulu, this is not applicable to you. This is only for Honolulu. But conventional actions, purchases specifically, not for refinances, that were closed in 2020 was a little over 5,200. For VA, over 2,300. That's a pretty sizable number. For those of you who may not know, Oahu houses every single branch of the military, which we're super proud of to have. And likewise, they make purchases. A lot of them do not want to live on base or rent, and they make the smart investment of wealth building and purchase properties to the tune of 2,384 purchases using a VA loan. What else do we have here? We have FHA, 210 were closed. Not a big number. Not a huge number at all. Agreement of sale. Agreement of sale is basically a land contract. It's a form of owner financing. I have a lot of people that will ask, will the seller carry, will the seller finance? And the answer is it depends on the circumstance. But if you look at the pool of potential, 4 in the entire year close in 2020. So I wouldn't focus too heavily on agreement to sell. It's tricky. It benefits the seller far more than the buyer. For those of you, this is the example that I've given. For those of you who are on the mainland, because you don't see that here in Hawaii, but you ever go on a road trip in the mainland and you see this giant billboard, usually spray painted or hand painted, and not like an actual billboard that's produced by a graphic artist or something, and it says, 40,000 acres for sale for whatever amount it is, and it always sounds like an amount that's too good to be true. Owner will finance. If you see that, that's likely an agreement of sale. And I'm not saying that it's a scam, but it's certainly a thing that happens often in rural area. It's always a rural area. It's never in a city where land is worth anything or there's a huge demand for it. And the answer for that simply is because if there were, people would just buy it. They wouldn't need to put a billboard that you made yourself. It would sell. And in today's market, if it's a hot item or hot product, it'll sell, within hours, if not a couple of days. But the whole thing with that is the seller would finance it, and title doesn't transfer until you make your final payment. And if that sale or that term of that contract is 10 years, for instance, the buyer doesn't receive conveyed title until after they made their final payment 10 years later. What typically happens is it's such a small amount of money for a piece of land that is really not worth a whole lot, that the buyer eventually just gives up and stops making payments. And if they do, there is no foreclosure that's required. They just evict that buyer and they take the property back. So they skip the whole foreclosure process, which is why you don't convey title. So it is something that, and then they put that billboard right back on the market again and get another person that might be interested in making that payment. So again, not that it's a scam, but it can be used for that purpose. Here on Oahu, you see it come up where it might be a unique property that's hard to finance, or a buyer that doesn't qualify for traditional financing. That's where it shows up. So 4 of them closed in 2020. That's not a huge number. Construction loans, 10 of them closed in 2020. Construction loans prior to the mortgage meltdown was pretty huge, depending on the area that you were in. You don't see a ton of them anymore. Commercial loans, 141 in 2020. Obviously, they vary in size. Some commercial loans could be small. Some commercial loans could be in the multi-millions. Balloon loans, 20 of them closed in 2020. My guess on this, I taught this class yesterday to our firm, and my guess on this one is that's probably hard money. That's investors or individuals who are flipping property, because that's the type of loan. Hard money, private money, portfolio loans are, for the most part, are balloon loans. So they might be at a 1 or 2 year term, of which after that term expires, the entire amount is due. And it's unlike an ARM, which you'll see right next to it, which is 21 of them closed in 2020. An ARM will become adjustable after its fixed period, whereas the balloon loan, the entire amount becomes due, which is indicative to hard money loan for the most part. So those are the types of loans that were closed in 2020. I thought was very interesting. Obviously, this excludes cash buyers, which there's a whole bunch of as well. So this is a question I get asked all the time, which is, in terms of a mortgage, which is better, or what's the difference between a pre-qualification versus a pre-approval? Let's look at it. So some lenders will kind of interchange this terminology, and it should not be, but a pre-qualification is a credit check in most cases. And I would say in most cases, because some lenders will do, if you don't want to have your credit ran and you call a lender, one of the big name lenders, perhaps even on the mainland, and you say, here's my credit score, I just checked what it is. They'll run with that number. I've seen it many times before without checking themselves. They'll do a verbal confirmation of income. That's simply, hey, Mr. Smith, how much did you make last year? Oh, 100 grand, fantastic. And then they just write that number down. Verbal confirmation of employment. Mr. Smith, where did you say you work again? And how many years have you been there? Awesome, great. Well, here you go. You're approved for a purchase of $1 million. And then they'll send you a letter that say that you've been pre-qualified. So what's the problem with that? It depends on the circumstance. I mean, it depends on, are you as a buyer, or if you're an agent that's watching this, you got to make sure that your client qualifies for what they're purchasing, because there's nothing more frustrating. Even put yourself in the shoes of a consumer. There's nothing more frustrating than looking at property that you just don't qualify to purchase. I mean, that is unbelievably irritating and frustrating, and you feel like someone has made a mistake. Why am I looking at this property? You're going into the process of making an offer. You get your offer accepted, only to find out while in escrow, after you put in earnest money deposits, after you've already paid for home inspections, to find out that from the bank that you don't even qualify for this property. And at the end of the day, it comes back to and circles back to that lender that they might have chose to work with, or the one that you may have recommended that they go and work with. Pre-approval is they run your credit without a doubt, pulling your credit. And not only do you see the credit score, but you also see all the debts that come up associated with your credit score. So if you have vehicle loans, student loans, mortgages, even derogatory items. Derogatory items could be bankruptcies or liens or anything like, or all these things show up. So number one, they have your credit, so they're verifying all that. The income is documented and verified. So the difference between a verbal and a documented is, please, email, scan, fax me your W-2s and your tax information, and as well as getting your employment information. All those things are verified. So it's a very strong approval. They know exactly what they're looking at, and this is certainly helpful if you have a client or if you are self-employed. If you make commission or earn commission, or you've had a change of employment or industries within the last 2 years, that's super important. You want to make sure that you qualify without getting started on the process without doing so. So there's a huge difference between pre-qualification and pre-approval. Should you work with a client that's been pre-qualified and not be pre-approved? Yeah, you can. Obviously, you just want to make sure. There are certain industry. I'll give you military. I was talking about military earlier, but let's say that there's a military individual who's active duty who has been pre-qualified with a credit check. It's a strong approval for sure. That's not a big deal to work to avoid working with, and the reason is because if they're active duty, their income is actually public information, depending on their rank. But if they are self-employed and they say I've been pre-qualified, and for a fact that that's all they've done is have that pre-qualification, you're going to want to dig a little bit deeper to make sure that that lender has all the accurate information in terms of tax returns and had a better understanding of how long they've been self-employed. That can come back and bite you later. So where can you get a home loan from? I think there's a lot of misconception as to how this works, and I'll break it down for you. So as simple as possible, I made these little circles. This is literally what I do with clients when I sit down with them and I go through a buyer consultation. My job always I view as I want to educate them about the process. If they can walk away from having a buyer consultation with me and feel as though they've taken a real estate class, then I've done my job. And I literally will take a blank piece of paper and I'll draw 3 circles and I'll write bank, mortgage broker, and direct lender in it. So here's the explanation for them. You can get loans, a mortgage loan, and a reasonable one from any or all 3 of them. But they all have different business models, functions, and therefore, interest rates and service and timelines and so forth. So banks and credit unions, you ever walk into a bank and you are depositing a check or taking a withdrawal, or you're at the tellers and you see on the counter a little sign that'll say, today's interest rates for 30-year fixed are whatever it is. Let's pretend for a moment, for the sake of this class, that going forward, today's interest rate is 3%. Okay, so on the market, 3% is the interest rate you can get. So you walk into your bank, you see at your teller's desk, it says 30-year fixed rate 2.5%, or 15-year fixed rate 2%, whatever. And they might have a equity line of credit or a HELOC that's also available. They typically have 2, 3, 4 items that show up on there, and that is it. And then when you look at the fine print, it says this interest rate of 2.5%, as I mentioned, 3% is the going rate. This interest rate of 2.5% will cost you X, whatever X is, and it's usually to the tune of 1 point, 1.5 points, 2 points, 2.5 points, whatever that looks like. Well, those points are the cost to do that loan with them. It could be in the form of origination and buy down. I'll explain what the differences are between them and in a couple of slides later. But banks you can get great deals from a bank, fantastic deals, but it oftentimes will have a huge expense depending on who that bank is, because their primary source of business is not doing mortgages. Their primary source of business is taking deposits, whether it's checking, savings, giving loans to student loans or vehicle loans or personal loans, as well as mortgages. They could care less about unbelievable competitive service and fees and interest rates for just mortgages. That is a small fraction of their entire business. So know that when you go in, it really comes down to it's a matter of convenience for you as a consumer walking into the teller. You're doing business, you pass by this loan officer's desk who typically doesn't have anyone sitting in front of them, and then you walk up to the teller and then you see this sheet that says, hey, today's rate is 2.5%. If you don't know what you're looking at, you're not going to realize that it comes with a great expense, number one. Number two is they're just hoping for the convenience of putting all your banking all into one source. If you bank at Bank of America or Chase or Bank of Hawaii or whatever it is, they just wanted to consolidate all that business, but it not necessarily is the best place to do business. It is great for when they have specials. They have some specials for equity lines of credit that are very inexpensive at low cost and low rates. Fantastic. They are great for refinance when there's no timeline that you need to work on, and they have a special on low closing costs. But generally speaking, for purchases, I would say not necessarily the best place to go. Mortgage broker. Mortgage broker, as a general rule of thumb, has no money. What they do is they are the middleman between banks and lenders, and then you as a consumer. So if you come in and you have a unique type of property, let's say it's a condition, the property is great. Let's say that maybe it might be a mixed use property, meaning that it's residential as well as business use type of property, so it doesn't fit with the normal lending guidelines. Or maybe you yourself have a unique situation where you have decent credit, not great credit, and you might have a bankruptcy that was kind of recent, or you can't verify all of your income or some of your assets. There's just a lot of exceptions that are piling up. Well, Bank of Hawaii or Chase or Bank of America, they're not going to do it at all. That's out of the question. But you might go to a mortgage broker because they might have access to hundreds of lenders and banks here locally on the islands as well as in the mainland that might be more than happy to work with that situation. So that's where a mortgage broker would come into play. The downside with a mortgage broker is they have no money themselves. They are just a middleman. So they don't have control over timelines whatsoever. Sometimes, not always, sometimes they can be at a higher cost because you're paying for them to be the middleman, to have found and sourced you directly with the lender or bank that they've had an approval for you with, right? So lastly, there's a direct lender. Direct lender, I would say by far and away, under normal circumstances, is the best place to go to get a loan or to get your clients pre-approved, because a direct lender does nothing except mortgages. They don't do deposits. They don't do car loans. They don't do student loans. They don't do personal loans. They don't, do checkings and savings. That all they do is mortgages. That's the just mortgages, and it is their money. So it is their money. They take the risk. They're the ones that can pass on a tremendous and typically huge amount of savings. So having a loan, I'm sure you guys have heard this term before, no points, no buy downs or origination fees or what have you. The likely source of that type of loan is going to be through a direct lender. Direct lenders typically have a decent menu of loans that they can provide to you, not as broker, but enough where you can get the job done and not as limited as a bank. So there's different sources. It is important to know the differences on why you would go to one versus another, but hopefully that'll explain. So closing costs. This is a question that oftentimes comes up, especially with new agents ask this question all the time, but certainly buyers and consumers want to know too, like what's the difference, why origination? What's that even mean, and discount and so forth. So here's the long and short of it. Origination points is kind of, fluff fees. It's just the cost or the fees that a bank might be charging you just to do business with them. The bank, the example that I gave you earlier with the bank, going into a bank and paying, 2 points just to get an interest rate and to do business with them, even if it's close to what the normal interest rate would be on the open market. That a lot of that is just built in origination points. It's a huge cost just to do business with them. Whereas the difference between it, so ideally, you don't want to deal with origination points if you can avoid it. But discount or buy down points, it sounds the same. It looks the same. I mean, it goes, when I say points, it's literally a percentage point or points or a combination of a percentage. So typically it's worked out to be a point and a half, 2 points, whatever it is. There could of course be a flat fee, but you don't find that too often. Discount or buy down points, it looks the same, but the intention is much different. So if it's categorized in a different line item like that, it is heavily regulated. You can trust lenders and banks that they are doing the right thing. It's so regulated. It's not like it was 20 years ago. But discount and buy down points, what that simply means is if the going rate, as we mentioned before, is at 3%, and you said, you know what, this is the home I'm going to be in forever. I'm going to stay in this loan for a long period of time as well. But I want an interest rate that gives me a lower and more comfortable monthly mortgage payment. You can opt and request to buy your interest rate down. And so basically what you're doing is you're paying a fee in the form of points to get an interest rate that the market does not have available. It's under the market. So if the market is at 3% and you want an interest rate of 2.75 or 2.5 or 2.25 or whatever it is, you're going to be paying points. There's not a simple math to it. It's not 1 point for every quarter point that you're saving in rate. It depends on what the market is doing. It prices it out completely differently. And interest rates, by the way, move kind of like the stock market, but you don't see it as a consumer like that. We see it typically in eighth of a point increments, and typically, unless there's tremendous movement in the secondary market, you only see typically interest rates change once, if not twice a day. So it's not a tremendous amount of movement. But discount points is not always a good idea. It can be a good idea depending on what your overall goals are. So if you, for instance, if you are planning on being in a property for a very short period of time, or an unknown, like you say, I'm going to buy this property, I might keep it for 2 or 3 years, and after that, I'm not sure, I might sell it or what have you. If you pay a tremendous amount of fees, including a discount or buy down points, you're kind of handcuffed to that property now, right? Because now you're stuck there. You've already paid a certain amount of fees, and the cost to recoup that buy down or those costs paid, if you plan on leaving in 3 years and it takes you 5 years to recoup that cost, then you overspent. There's no reason for you to have spent that much money. So the idea is to ensure what your plan is. If you're an agent and you're working with your client, Mr. Client, what's your long-term plans on this property? How long do you intend on being here? How long do you intend on being in this specific loan? If it's unknown due to their lifestyle, or maybe it's an investment property, or maybe whatever their goals are, a discount or buy down points might not be beneficial to them. But you got to do the math. Every situation is completely different. Then there's underwriting and processing fees, which you can kind of categorize as lender fees, and that's basically the fee that the lender charges. And there is, real costs that are associated with doing business, but that's what the lender fees are. Typical lender fees, including underwriting and processing and all those kind of things, are anywhere between $800 to $2,000, depending on the lender. Some lenders will tout that they have no lender fees at all, which is great. You just have to do the math and figure out if they're reasonably cost, if their cost is appropriate to other and comparable to other lenders too. Appraisal fee is exactly what it sounds like. It's to pay for the cost of a third-party appraisal. And the appraisal, if you're getting a loan, an appraisal is required. And it's not really for your benefit. And there's a slide on this, and I'll get to in a moment too, but the appraisal is for the benefit of the lender, to ensure that the lender is putting a lien on the property that's an appropriate amount relative to the value of the property. So it is, the happenstance is that you get the benefit, you as a buyer, or your clients get the benefit of ensuring that they don't overpay for the property, but in reality, it's for the benefit of the lender. Prepaid interest and prepaid impounds, which is tax and insurance. So prepaid interest, which is also known as per diem, if you rent a property. So I'm going to give you this example. We're in July right now, so August is coming up. If you're a tenant or you rent, your August 1st rent payment is paying forward. You're paying for the month of August. However, if you are a homeowner and you pay a mortgage, your August 1st payment is paying in arrears. You're paying for July. So if you close on a property, let's say you close on August 1st on a property, your first payment is not due until October 1st, right? So you're skipping a month. You're not really skipping a month, you're paying in arrears, and therefore you have to prepay the interest or the per diem for the month of, in this example, for the month of September. So that's prepaid interest. That is not fees in terms of like junk fees. That is the interest on your own loan. So sometimes people, I've seen buyers or borrowers look at their statement and they're saying, hey, look at all this, I got $5,000 in prepaid interest and along with another couple thousand in tax and insurance. What's all these junk fees? Not junk fees, it's you're a homeowner now. That is the interest on your own mortgage as well as the tax and insurance on your own mortgage. So those are not unnecessary fees. Title and escrow. There are absolutely escrow fees and absolutely there's title insurance. Escrow fees, an escrow, if you guys don't know, is a neutral third party that holds the funds and ensures that all parties are aware of funds being delivered and received, and they kind of manage all the payoffs and so forth. And there's a fee for that. It's not a huge expense. Every escrow company is a little bit different. Could be as little as $300, could be as much as $800, sometimes more, depending on the loan size and so forth, and the state that you're in. Title insurance, there's typically two types of policies, standard and premium. You should ask your title insurance company what the differences are. On the properties that I've purchased, I've always purchased a premium policy because they cover more things. Title insurance, for those of you who don't know, is not a premium in which needs to be renewed monthly or annually. It goes along with the property for the duration of the time that you either own it or until you refinance or sell that property. So for instance, if I buy a property, I have title insurance on that property, obviously, which is required. So I have title insurance upon closing, and I don't sell the property, nor do I refinance for 15 years. That title insurance policy is still intact for that time frame. If, however, I own the property for 15 years, but I refinance in 5, I got to do another title insurance policy for when I do a refinance. Then there's recordation fees. It is exactly what it sounds like. That is the fees at the county level to record your name on title. And HARPTA and FERPTA is unique to Hawaii, so anyone that's outside of Hawaii that's watching this doesn't apply to you, but these are investor assessments that the county and state are required to take upon selling. So HARPTA is U.S. citizens, but out of the state, so out of Hawaii. They might reside in California or Washington, just not in Hawaii, and they're selling an investment property that they don't occupy. And FERPTA is for foreign investors. So you might have an investor that's not a U.S. citizen that is an actual foreign investor in another country, and that's the fee, and which is a higher fee, by the way. So those are fees that they would collect in those circumstances. So how do LOs, loan officers, and mortgage companies make money? This slide's a little small, so I'm going to try to see if I can get my face out of here, make that a little one that didn't really help much today. All right. Okay, so this is a rate sheet, a sample rate sheet. It is not applicable for today's rates. It's not even the point of it. But what it does do is it shows you that you guys have heard the term lock before. Hey, I want to lock my rate. This is how long my lock is good for. Every lender's a little bit different, but generally speaking, you can lock a rate as, I've seen 7-day locks. In this case, it says 21-day, 30-day, 45-day locks. What you'll notice, and I'm going to grab a number just to give you an example. If you look at the column to the far left where it says 21 to 30-year fixed, -101, the rate we're going to look at is 3.125. So on a 21-day lock, if the loan officer, the mortgage company, the bank, whatever it is, locks in your interest rate, first and foremost, you should know how many days you're locked for. You should have a grasp on what that means, because that is important. Once your lock expires, someone, which is usually the buyer or the borrower, is going to have to pay for a lock extension if someone can't close in time. So it's super important to understand that. But if we're looking at 3.125, that's 0.444. That is at a cost. So if you as a buyer want 3.125 on a 21-day lock, if we're looking at this as a rate sheet, it's going to have a cost or a buy down of 0.444 as a percentage of the loan amount that you're getting. And that's your cost. So that's your buy down. That's the points that we're talking about before. Using another example, if you wanted an interest rate of 2.75, if you notice, that has a cost of upwards of 2 points, 2.045. So the lower the interest rate that the market doesn't yield would have a tremendous cost. And obviously 2.25 is something, most of these you can't even though it says it on the rate sheet, you can't get it. But 2.25 has a cost of 5.213. So 5 points, 5 percentage points. Whereas 3.25, if you look at it, it's in parentheses 0.3, that's 0.260. So 0.260 is the profit. So there's a credit established, which that credit can either go to the setup of the mortgage company, the broker, or the bank. All of them are a little bit different, but that's where there's a profit that's built into that. So the loan officer themselves might make that. The loan officer themselves could say, I'm going to credit back the buyer or borrower on that loan. These are just regular 30-year fixed loans, but I'm sure you guys have seen this before where if you guys are in the industry, if you're agents or if you're a buyer who's using a VA loan, there are lenders, and it's most common here in Hawaii, that the lender will pay for your closing costs. So how do they do that? They do that by simply increasing the interest rate. So let's pretend for a moment that this is a VA loan that we're looking at. This is not, but let's say that it is. And there is some costs, like a few $1,000s worth of closing costs that you would like the lender to absorb. The way to do that is instead of charging the going rate, which we call the par rate, which is 3.25%, they would charge you something like 3.75%. So the interest rate would be higher, but that whatever it is, $10,000 worth of closing costs may be absorbed by the lender entirely, because the lender now has 1.391 percentage points of credit or extra funds to work with that they can apply to pay off or reduce or completely eliminate the borrower's closing costs. So as a buyer or borrower, you're paying for it in one way or another. You're either paying for it by writing a check in addition to the down payment for the closing costs, or you're paying slightly higher of an interest rate, which comes out in your monthly payment. Is there a right or wrong? Is this the wrong way to do it? It's all, you have to just do the math. There is absolutely no wrong way to do it, but I can tell you more often than not, for a VA to have the lender pay for their closing costs typically makes far more sense than the veteran to pay it themselves. And the reason is because if the closing costs are on average $12,000 to $15,000, when you do the math, it would take them, the veteran, 5, 6, 7 years to recoup that savings if they had to cut a check for $12,000 to $15,000 versus the lender paying it all in one shot when the veteran is only going to be in that home and on island typically for 3 to 4 years. So it depends on the circumstance. Don't expect a more general answer. Do the math. If you don't know how to do the math, reach out to me. I'll kind of explain that to you. But there's a way how many months it's going to take to recoup that. But it's super beneficial. If you notice, it's just kind of a zoomed in version. If you notice, I created that box. That box is where the bank or loan officer has credit or profit that they can toy with. They can use it to pay closing costs, offset fees. Whereas above that box, you'll see everything is at a number that's relative to that you see in there. For instance, like I mentioned before, the 2.25% interest rate on a 21-day lock. It says right next to it 5.213. That 5.213 is a cost. So in order to get that rate, because that rate is not available on the open market, one would have to pay 5.213. So who's that person that would pay for that? Could be the buyer, could be the loan officer, could be the agent, could be the seller, depending if you negotiate that in. So that's all a matter of negotiation. This one's harder to see. I'm not going to focus too much on this, but a lot of people, especially when I was in mortgages, I don't do mortgages. I'm still licensed in many states to do mortgages. I don't do mortgages anymore. I never want to do another mortgage as long as I live, but I keep my licenses active so that I can teach classes like this and I can give advice to buyers or clients and be an advocate for them. But I've had this happen before where people would call me and say, hey, my neighbor across the street got whatever 3% and I got 3.25. I got ripped off. Well, maybe, but not necessarily. There are things that are called adjustments, and adjustments are how lenders and banks factor in risk. And there's a variety of different ways they do that. And some of it is based on FICO score, which is your credit score. So if your neighbor across the street has a 740 FICO score and you have a 650 FICO score, yeah, you're paying a higher interest rate because you're not as credit worthy. Your risk is much higher. Likewise, it's not only credit driven. There's other factors too. There's equity. So if you look in the, I don't think I can get my mouse on there, but if you look in that bucket that's right underneath on the left-hand side, it says subordinate financing. There's LTV, CLTV, FICO adjustments. So it also goes in hand with if you have a second mortgage or a HELOC that's being financed concurrent with your first mortgage, the equity that you have in it. So if you notice, the scale goes all the way up to 95%. So if you're at 95%, there's far more adjustments. There's a FICO score adjustment I'm looking on here. There's a 0.75 adjustment for 95% loan to value. Whereas at 60% or less for 740 FICO score, there's no adjustment at all. So you come in with unbelievable credit and you have 40% equity in the property, there's no adjustment. You're going to get a raw rate as a general rule of thumb. You're going to get a raw rate. But if you have great credit at 740 plus FICO score, but you're financing up to 95%, yeah, you're going to be paying an interest rate or cost much higher than someone who wouldn't have that. So there's all kinds of factors that play into risk and so forth. So bear that in mind. That's the reason why interest rates or cost of the rate come into factor depending on who that buyer is. Don't always assume that someone's taking advantage of you, the lender's ripping you off. It could be you. It could be the type of property that you're purchasing. It could be a variety of different things. Appraisals. So appraisals from an agent's perspective, super necessary as a part of the financing process, but it's kind of like the bane of our existence. Appraisals are hard to deal with because it's an opinion of value off of one individual is qualified. They are licensed, they're a neutral third party, but it is absolutely an opinion of value. So going into the slide, appraisals for the benefit of the lender. I kind of mentioned that in the beginning. It's to determine risk in lending. It's not for the benefit of the buyer. The happenstance is that the buyer gets the benefit of it. Appraisals are ordered through an AMC. So what's an AMC? An AMC stands for an appraisal management company. It's something that was instituted as a response after the mortgage crisis and mortgage fallout in 2009, and for good reason. Prior to that, what would happen with loan officers, whether you're doing a refinance or a purchase, is you would just pick up the phone and call an appraiser. Hey, John, I have a purchase that I just opened up escrow for. Can you go do the appraisal on it? It's at 123 Main Street. And he'd be like, yeah, sure, no problem. He would go out there and do it, and no big deal. What some unscrupulous loan officers or lenders or brokers were doing, why they instituted for good reason the AMC and that process, was they would say, hey, John, I got a purchase that I opened up escrow for. Listen, I really need you to bring the value in at X, whatever X is. So they created this process to basically make it a blind ordering process, whereby as a lender, and I say as a lender because real estate agents are not part of this process in any way, shape, or form. So there are some agents that will ask, like, how do I order the appraisal on behalf of my? You don't. You're not involved at all. Just stay in your lane, which is the real estate side of it. Let the lender do their thing. What the lender does is they place a request to have an appraisal to the AMC, the appraisal management company. They don't know who the appraiser is. Let's just call it Superior AMC, whatever that company's name is. It's an order, and Superior AMC will go through a blind process and select the appraiser that's available to do that appraisal. And then you're notified, the listing agent is, because that appraiser then, sometimes it's the AMC, but most often it's the appraiser that will call the listing agent to say, I've been assigned to do an appraisal for your listing at 123 Main Street. Can I, come in and do the appraisal inspection on Tuesday at 3 o'clock? That's when you typically, as a listing agent, might be notified of who that actual appraisal is being done by. So appraisals can take a variety of different time frames depending on the workload of the appraiser, of the AMC that's involved in it. Right now, as you guys probably know, we're going through a purchase boom and especially a refi boom because of how low interest rates are. With all that being said, it typically is taking between 10 and 14 days There are some lenders and some appraisals that can get it done much quicker, and there are some that are taking much longer. There are some 30-day escrows that are being extended specifically because the appraisal is taking so long. So for additional, type of outside of conventional, outside of that conforming Fannie Mae, Freddie Mac stuff that we talked about, which is the Govy loans, VA, FHA, USDA, there is some other things that are required in order for that appraisal to be able to do that type of appraisal. So super important to know and make sure that as an agent, and I'll get to the next slide momentarily, but as an agent, you got to make sure that you are indicating what kind of loan that it is. Because if you don't, and it causes a delay or causes the wrong appraisal report to be conducted when it should be a VA loan and it was done as a conventional loan, you're causing a delay on yourself. Everyone's going to be upset with you. I just talked about how the locks work, and that just simply means that someone may have locked the wrong type of loan, or a lock would have expired because they got to go back out there. So do yourself a favor, be super diligent and detail oriented, and make sure that you're expressing what kind of loan it is and write that into the contract. I mentioned before, while appraisers are sometimes the bane of realtors' existence, they're necessary. And more importantly, they are qualified. They're licensed. It costs, or not cost, but it takes about 1,500 hours for them to become an appraiser. So not to be taken lightly, that's far more hours and time spent. That's a requirement for them to be licensed than it is a real estate agent, which, by the way, I hate that we have such a low barrier to entry in our industry. It should be much higher than that, but nonetheless, it isn't. And appraisers are required to have 1,500 hours in order to become an appraiser. They know what they're doing. As a trick question, do you guys know how long it takes for an appraisal report to expire? Like, when's the expiration of an appraisal report? And I asked this question yesterday. The typical answer that I've seen is 30 days or 45 days or 60 days. That's actually not true. The appraisal expires the date of the appraisal. So what an appraisal is it's a snapshot in time, just like a credit report. And I'll get into that afterwards too. But an appraisal is a snapshot in time. So the date of the appraisal shows what the comps are, shows a couple of active listings, but most importantly, what the sold properties were. So it's a snapshot dated. If it's today's date, it's showing what's closed as of recent. It's not going to show if one of the listings that closes tomorrow or the week following, it's not going to show that in there, obviously. So it's really expires that day. So when the question came up and someone said 30 or 45 or 60 days, what they're really referring to is the amount of time that a lender will accept an appraisal. Because obviously you can't get an appraisal and underwrite it and close on the date that's on the appraisal. That's not possible. The appraisal is done, the inspection's done, the appraiser goes back and does its report, formulates the report. It's anywhere between 16 to 30 something pages, sends it. There's all this time. There's things that have to happen, underwriting and so forth. So it's impossible for it to be done that same day, which is why lenders accept an appraisal anywhere from 30, 60, 45 days after the date of the appraisal. Otherwise, they need a refresh on the appraisal to have it, added more information to it. Appraisers can oftentimes point out deficiencies or safety issues as they see them. Most are not contractors, but they are obligated. They're the eyes and the boots on the ground for the lender to ensure that the property that the lender is putting a lien on is sufficient and warrants getting a loan on, or warrants even having a lien on it. So, a lot of real estate agents will often go, "Oh man, this appraiser just screwed up my whole transaction because he pointed out that the roof was, has some watermarks on the roof." What I would say is, be an agent that's a little forward thinking. And if it's your listing and you're going out on that listing and you notice that when you're doing your walkthrough prior to it even going on the market, prior to it going on to the MLS, why don't you ask the seller, by the way, what happened here? Is there an issue here? Do we need an inspector to come in and take a look at the roof or whatever it is? And if the answer is no, we've already taken care of that, that's just a stain, but this has been addressed on this day, whatever the case is, get all those notes, get those receipts, get that information ready for the appraiser when he or she comes out to do the inspection. I mean, what a time saver, right? Just be there. Here's, by the way, there's a stain up there in the corner that you may ask about, or you may see. This is the information that they've already had that repaired last year. Whatever the case is, you're just saving yourself so much trouble, because if the appraiser puts notes into the appraisal like that, the underwriter is going to see them, and oftentimes it can delay or completely derail your transaction. So you should also get ahead of those kind of things too. VA appraised values maintain their value for 6 months. So what does that mean? Even if the transaction didn't close, but the appraiser is ordering a VA appraisal, which is going through what we call the VA portal, which is done through the VA itself. An appraiser comes out to a property, he assesses the value and deems this property valued at $600,000. Let's say that the transaction did not close for a variety of different reasons. Maybe they canceled due to the home inspection or whatever. Maybe they didn't qualify because someone bought a car while in escrow, which is never a good idea, and it falls out of escrow. Well, if another buyer comes along and they are also a VA buyer and they order a VA appraisal, there's going to be an alert that comes up that says property value is already deemed $600,000. So that value that was done by that VA appraisal prior sticks on record, sticks in the VA portal for 6 months. This could be both good and bad depending on what side of the equation you're negotiating on. So if you're on the buy side and it's $600,000 and the seller wants $650,000 or $700,000, they're not going to get it, not from a VA anyways, because that appraisal is not going to be increased unless the veteran wants to overpay and pay out of pocket. So depends on how you use it. I teach a strategy negotiation class on the purchase contract on all these different kind of components too. So if you need help with that, you can reach out to me and I can talk to you about that. Here's a copy of just one of the pages in the appraisal if you guys have never seen it before. Where I have highlighted those square blocks going down, those vertical blocks, those are the comparable sales. And typically, this is only on one of the pages. There's another page. There's many pages, but the comps or the comparable sales typically take up to sometimes 3 pages. So an appraiser will typically list 5 to 7 roughly comps. The one that's on the far right is the subject property. That's the property he's doing an inspection on. And what you're seeing in those squares is the appraiser doing an adjustment to benefit to either take away value from the subject property. So there's no such thing as 2 properties that are identical, even if they're built in the same year. Their condition is different, their upgrades are different, their colors are different. A variety of different things can change it. But in most cases, what you see is, this property was built in 1990, and this one was built in 1970, and this one is 4 bedrooms, and this one is 3 bedrooms. Sometimes people would say, why is a 4-bedroom property even showing up as a comp when mine's a 3-bedroom or vice versa? They want to go for the model match. Everything's identical. Bedroom, bathroom, square footage is identical. However, if they can't do that, they're going to insert something else, and then they're going to insert adjustments to offset that. And that's where you see those, plus $5,000 or minus $15,000 or plus $1,000, whatever that is that you see on there. They're going to make an adjustment depending on, how it compares to the actual comps. Underneath that, you're going to see a little highlight that says Tidewater Notice. That's specific to VA. What Tidewater is, and it doesn't, I wish that there was a Tidewater Notice for all kinds of appraisals besides VA, but it's unique to VA. What it basically is it's saying that, hey, agent, from the appraiser, hey, agent, or all parties, I don't have enough data to support your value. So if you have more information that I should know, whether it's upgrade information or other comps that may have closed that I'm not seeing, or maybe something that is closed off market that you are aware of that I'm not aware of, please send them over to me, because this Tidewater Notice is me giving you a heads up that if you do nothing at all, I'm probably going to not bring in the value as the value that what you're in contract for. So it gives all parties an opportunity to provide last minute information to the appraiser. So Tidewater Notice is bad. And if you're on the list side, if you're on the buy side, you might get the property for cheaper. So it could be good. That square underneath it is the sales, basically the value that the appraiser's coming in with. And underneath that is super important. A lot of new agents especially don't even see this. It says the property or the value is as is, which in this case, this one is marked as is, or the box right next to it is subject to. Let me tell you something about subject to. Subject to, it makes me tremor in fear. It gives me nightmares. I have had so many appraisals that have come back in my 21-year career, and it says subject to. Subject to means it's not done. You're not at the finish line. This appraiser or another appraiser has to go back out to verify something was completed. So what it's saying is subject to. It's subject to something being done or something being re-inspected. So as an example, that watermark on the ceiling that I gave you earlier, if that appraiser sees that watermark on the ceiling and he notes on subject to, it could be subject to a contract or a licensed roofer or a contractor going out there to inspect to ensure that there's nothing wrong, there's no roof leaks or what have you. Or specifically with VA and Govy loans, but unique to and specific to VA, VA is real strict on safety issues. Some of which is totally understandable. Exposed wire, I totally get that. Pool that doesn't have a fence or cover on it, I get that as well, especially for kids or what have you. But rips in screens, cracks in glass, it could be very small too. That could be a deal breaker or a hindrance in getting a VA loan. So as an agent, again, a lot of agents sometimes defer and go, oh, the lender screwed this up, or the loan officer screwed this up, or the appraiser screwed this up. A lot of these problems you can see a mile away if you just think and focus on what the situation is, right? So if you're a listing agent, you're taking on a new listing and you see, again, spots on the ceiling, or you see rips in screens, or you see cracks in glass or exposed wire. Prior to even going on the MLS and going and marketing the property, have a conversation with the seller that if we don't fix these items, this could pose an issue on the potential demographic and buyers, or the pool of buyers that could potentially qualify to buy this property. We should focus on remedying this issue. Or if you're on the buy side and you're at an open house, or you're at a showing and you're showing the property and you see these things come up while you're doing the showing, you want to make mention to the buyer too. Hey, I noticed that there's a crack in the glass or there's a rip in the screen, and maybe put it into the contract. The seller or listing agent is going to remedy this issue prior to the appraiser going out there and seeing it themselves and risking it turning into a subject to. Because if you don't do that, that 30-day escrow that you had hoped to close on really quick because the buyer's so excited and the wife is already measuring curtains and measuring for where the couch is going to go, and the listing agent's so happy that you brought in a strong offer and they had a bunch of offers but you're going to close quickly and so forth. Everyone's going to be miserable at each other if someone missed the cracked glass or the screen that had a hole in it, and the appraisal came back subject to, and that 30-day 30-day escrow turned into a 60-day escrow because you have to reorder an appraisal to go back out again to reinspect, fixed. So a lot of these things, guys, are not the lender's fault or the appraiser's fault. They operate with the same list. It's our fault if we're not seeing it ahead of time. So just some advice. A lot of times people ask if a comp they can use is like in a different city or area. The answer is here's the thing. If your subject property is a castle and the nearest castle is 10 miles away, then the answer is maybe. Maybe they're going to go and appraise and comp the castle that's 10 miles away. I don't know about you, but there's only one palace here, but there's no castles here anyways. This is literally a map of an actual appraisal report of where in the neighborhood. By the way, this is all the same neighborhood, but it's where in the neighborhood the subject property is, which is located in red, and all the comps are relative to the subject property. So what an appraiser is going to do is he's looking for closeness in time and closeness in location to the subject property. Time meaning if it's a property that sold 3 years ago, it is not a comp. It has nothing to do with anything. But he or she is going to be looking for close in proximity, both in time and location. All right. Got some good comments that are coming through. Thanks for that. Okay, so myths and facts about credit. There are so many of them. Here's one that I find unbelievably irritating for some reason is people will go, my FICO score is super high. It is. Let me just tell you, ladies and gentlemen, it is not a FICO score. It is a FICO score. Stop calling it FICO score. It is FICO. FICO score or credit score. Another thing that is a myth is when, people think when they run their own credit, because you can do so on Credit Karma, you can actually order your own scores through the individual bureaus themselves. You can call TransUnion or order it on transunion.com and order your credit score. I think you're allowed a free credit report once a year. And the purpose of that is to see if there's any misinformation or erroneous information that's on there. And it is a good idea. If you're credit conscious or you're thinking about your future, I'm always looking at my credit because I want to make sure I'm always in a position, if an opportunity presents itself, whether it's for business or whether it's for buying properties or what have you, that I'm ready to go and I'm already qualified. But if you run your own credit, your score is typically going to be much higher than that of a mortgage company or a lender running your score. Why is that? The reason is because when you run your score, it's a raw score. It's raw data. You are not you're not a lender, and you're not borrowing anything from yourself. So there's no risk that's applied or a risk score that's applied. When you are a company, let's say you open up a company and you apply to be able to have the ability to run someone's credit. What a lot of people don't realize is there's an industry code. Let's say that I open up I'm a Verizon store. And as a Verizon store, I got to run credit to determine if I need a deposit in opening up someone's new cell phone account, right? So when I apply for this and I have the ability to run someone's credit, they're going to ask me what industry that I'm in. The reason why they're going to ask me that is there is a layered risk that's layered on depending on the industry that I'm in and the risk factors that are applicable. So for cell phones, if I'm delinquent or late on a cell phone, I mean, what's the most that I could be behind? A couple $1,000s, right? Hundreds, I don't know. It's not much. So that layered risk or that filter that they apply to that on your score is very minimal. But if you own a car dealership, it goes up. So that risk is much higher. And you could, depending on if you're buying, or selling used cars or new cars or luxury cars or whatever, there's a risk that could be applied, $50,000, $60,000, $70,000. So there's a different risk, and your score will be a little bit lower. Well, imagine mortgage companies, banks, lenders. That's the ultimate risk, right? Because that's hundreds of thousands, if not a million plus, in terms of dollars that you could be borrowing or going into default for. So if you pull your own score, and you're like, oh my gosh, hey honey, look at this. My score is 800, and you're bragging and you're doing cartwheels or what have you. If you have Bank of Hawaii run that score for you for the purpose of getting you pre-approved, don't be surprised if that 800 score actually turns out to be 720. And the reason again is exactly what I said. There's a layered risk that's applied to that score. There's another myth that people think that if I have a mortgage company or a lender or a bank run my credit, I'm kind of stuck with them, because what I don't want is I don't want every bank or lender to run my credit, because my score is going to keep going down 5, 10, 20 points every single time. That's absolutely not true. You have, and this only applies to vehicle loans and mortgages. That's the only two things that it applies for, is you have an unlimited amount of inquiries within a 30-day time frame. And the reason why this rule applies is because it's part of the Consumer Protection Act, actually. And the reason why it applies is so that consumers have the ability to shop around. Otherwise, if you go to Bank of Hawaii, have them run your credit for the purpose of getting an idea of what your interest rate that you qualify for is, and let's say, hey, you qualify for 3%, but it's going to cost you $25,000 in fees, and you're like, oh my gosh, that's too much. You're not stuck with Bank of Hawaii. You can then go to another lender, mortgage company, broker, whomever you want to go to, and get an idea of what they would charge you both in interest rate and in closing costs. And your score is not going to go down. Your score is probably going to be almost exactly the same, if not one that you had before. Now, with that being said, I would never suggest someone run hundreds of times on your inquiry, because the flip side of that is all consumers are allotted a certain amount of inquiries on an annual basis. Each credit bureau, there's 3 of them, will not tell you how it's a proprietary algorithm that they use, and that's why your scores are different at each bureau. Like you might have 740, 735, and 720. They're always generally kind of in the same ballpark. But why is it all different? Because they have a different algorithm that they apply to, if you have 6 inquiries in 12 months, that's not a lot, that's fine. But it also depends on who you're inquiring. If you're inquiring to Ross credit card and the TJ Maxx credit card and the Macy's credit card, that's not smart, and that's not good either. But if you all have mortgages and it's all within that 30-day time frame, your score's not impacted at all. But you as a consumer or as an agent educating the consumer, educating the buyer, what you're going to want to do and make sure of is that you let them know what this process looks like, and you want to have all your ducks in a row. If they're talking to a lender, get the information who you're going to be using, with what lender you're going to, what mortgage company you're going to. You should know this within a week or two. Like, it should not be a process that's dragging out 3 months later. I've seen this happen before, where a buyer is selecting a lender to go with, and then kind of halfway through escrow, like, you know what, I think I'm going to switch lenders. And I'm like, okay, we're in contract right now, so you could, potentially lose money. Your score could definitely be impacted because you're well beyond that 30-day mark. So, as a real estate agent, I'm a big fan of being a consultant, being an advocate, making sure that you properly educate clients on how this process works. Generally speaking, 740 score and higher, generally. There's some unique programs, but generally speaking, it's all the same. You need 740, 745, 750, 780. You're getting the same rate. Your rates, you win. You got the best rate. 800, 740, you both win. The 740 and 800 typically, competing with one another. Like, 800's looking down at the 740, like, I'm better than you. Not really the case as it applies to mortgages. However, 739 is in a different bracket than 740. So that example that I gave you with all those adjustments, that adjustment is taken into account. So when you have a 739, you're in a different bracket. You might be paying an 1/8 to a 1/4 point higher in interest rate or more cost or fees as a result of having a 739 versus a 740. And then they go in brackets after that. There's like 720, it's usually 720 to 739 and 740 above and so forth. But yeah, 700, great credit. 720, even better. 740 and above, same thing. High five yourself. You did it. You've arrived. 740, 800, same exact thing. You do need a higher credit score and lower risk for a lower down payment or high risk loan. So the loans, Fannie Mae has or the conventional side has a loan program that's like 3% down. That's so low. That's lower than FHA. FHA is 3.5% down. So you can get a loan as low as 3% down. But you cannot get a 3%, and nor should you get a 3% down loan if your credit score is like 600. That's not a good enough credit score. That's high risk. So you absolutely have to have a high credit score to get the lower the down payment is. Even if you're splitting the loan up in two, like the example I gave before, a couple of homes that I had purchased was with 10% down. So 10% down, then I have a 10% second, and then an 80%. That I have really high credit scores, because the risk factor of the bank, even if it's split up into two banks, the bank is financing 90%. So you got to make sure that you have good credit scores for that. Otherwise, you can still get a loan, but you're expected to put down 20, 30, 40%, depending on the circumstances, right? FHA, as well as VA really, but FHA is the most forgiving when it comes to credit score, when it comes to FICO score. It doesn't mean, though, that this is how we got into this issue where in 2009 and the mortgage meltdown was, it doesn't mean every single person should qualify for a mortgage. I mean, the mortgage homeowners and those who qualify for a mortgage should be responsible and have the ability to repay, because our entire US economy, people don't realize this, is really the engine behind everything is home ownership and homes. Because mortgages are tied to that, and the stock market impacts mortgages and mortgage-backed security. There's so many different things, and the engine really is home ownership. So you don't want individuals that are credit challenged. Not to say that good people don't have bad things happen to them and go through different things, but you want to make sure that individual qualifies and has the ability to repay. Otherwise, you're setting someone up for failure. So, that being said, FHA does go as low as, but not to say, and to my next point, what are overlays? Not to say that a bank or lender can apply an overlay to that to say, yes, I know that FHA goes as low as 500, but we as 123mortgage.com, we will not do an FHA loan any less than 620 FICO score or above. And that's what an overlay is. So they have the ability to go lower, but they themselves will not go lower than whatever it is. So there are different type of overlays for different circumstances. If you guys have specific questions as to what that is or your scenario, just call or email me and I'll be able to answer your specific question. One that I get a lot of is, why can't you co-sign for a house like you would a car? The biggest answer is the dollar amount the value associated with that, right? If someone's co-signing in a car, if mom and dad are co-signing in a car, how much is that car? 30 grand, 40 grand at most in most cases. Really not a huge risk, and you can't occupy a car. Like, you can't live in a car. You can have the primary address or residence that the vehicle's tied to, but it's a different risk factor. With a home, there's such a tremendous risk, and some of that risk that they've come up with, they meaning Fannie Mae, Freddie Mac, and some of the standardization is property being owner occupied versus non-owner occupied. And there's a huge difference between the two in terms of cost and risk. So owner occupied means that obviously I live in the property. That's my primary residence. That is the place I call home. All the bills and utilities are made out in my name. That's what owner occupied is. Non-owner occupied means I do not live there, and more than likely in most cases there is a tenant that lives there. And so here's how Fannie Mae, Freddie Mac, and conventional standardized guidelines have all kind of arrived at this is, if you own two properties, let's just say one you live in and one that you don't live in, and you came on tough times and you could only afford one of your mortgages, which mortgage would you continue to pay? What's a no-brainer? You're going to pay the property that you live in, right? That's your primary residence, your owner-occupied property. You'd probably default or let go, whether intentionally or by design or by happenstance, go your non-owner occupied, your rental property. That is why those particular type of loans have huge adjustments, and you're paying that much more in interest rate or that much more in closing costs or fees, because that's a higher risk level. With all that being said, typically when someone is trying to co-sign on a home, the co-signer, or what we call the co-borrower, doesn't occupy the property. If it's mom and dad live in Idaho and you live here in Hawaii, and they're co-signing for you, that is a non-occupying co-borrower. And in many cases, for a lot of those loans, you're going to be, the lender or the bank or mortgage company is going to underwrite it as though it's always the highest risk factor. So they're going to underwrite it as though no one lives in the property. It's a non-occupied property. Interest rates are going to go up, closing costs will go up. And in addition to that, by the way, too, when you bring on more people onto a mortgage loan, like I mentioned before, you're underwriting at worst case scenario at the highest risk factor. So let's say that there's 3 people on a loan and 2 of them have an 800 credit score. So they have great credit. One of them has a 600 credit score. The lender is underwriting at a 600 credit score. So you bring with both good and bad. I mean, if that 600 credit score individual has no income, get them off the loan altogether. That's often why a lender might say, hey, husband and wife, we're only going to put the wife on and leave the husband off, or vice versa. That's the reason why they even say that, is because by bringing on someone who has a lower credit score could increase the interest rate or cost of the loan, because they're underwriting it to the highest risk or the worst case scenario. Works for debts as well. I've seen people that come in and say, like a spouse they want desperately to be on the loan. And typically that's an ownership thing. And it's just a myth or misunderstanding of what that looks like, but they want to be on the loan. They want to be on the document with the other spouse. But if this spouse doesn't contribute income or enough income, but they do contribute debt, now you just rolled in all the debt. So no longer might you qualify, all parties might not qualify for the loan, because you're bringing in debt along with that qualification. So that's the long answer on why you can't co-sign for a house. It's not that simple. You have to qualify, and they take highest risk factors into account when they underwrite. Some other things which I thought was interesting is FICO scores are made up of a percentage of these factors. So 35% of that FICO score is made up of your payment history. Obviously, that's self-explanatory. That's if you're paying on time and the duration of that. 30% of it is the total amount that you owe. The other part of it too is what you owe. Like it's your available credit scores as well. So the amount of credit that you have versus the balance of them and so forth. 15% of that is the length of your credit history. So if you are brand new to credit and you're trying to establish your credit and you've only had a credit card or any kind of item that's reporting to credit for 12 months, your score is not going to be as high as someone who has good credit for a longer period of time. It's that length of the credit history. New credit is 10% of your score, and the type of credit in use also contributes to 10% of that score. So I thought that was helpful. So I'm talking to Hawaii agents for a moment, is Section C2 of our purchase contract looks like this. You guys have seen this before. And this is where we put in information as to the earnest money deposit, additional deposit, if any. I talk a lot about this on a class that I teach called Strategies of a Purchase Contract, where we go into like the negotiation portion of it and how to strategize and how to really use the purchase contract as a chessboard so that you can understand and think at least 3 or 4 steps ahead in the escrow process and in the negotiation process. With that said, the reason why I even put this on here is because 2 things. Number 1 is where it says by way of, you guys should be putting in there what kind of loan it is. I mean, it's not that difficult to put, but a lot of agents I see by way of 30-year fixed. Well, okay, 30-year fixed what? FHA, USDA, VA, conventional. You know, as a listing agent, if you're receiving this, that's the first thing you're doing is looking at that to figure out, okay, what's the down payment now? What kind of loan are they getting? Don't make people do math, especially if you're on the buy side and you're writing an offer to benefit your client and you're over. Make the job of the listing agent so easy to want to pick you as the person that they want to do business with and open up escrow with. Make the job easier by way of a new conventional 30-year fixed mortgage, rates and terms acceptable to buy or whatever, or by way of a new VA 30-year fixed mortgage or whatever it is. Like put what kind of financing that it is so they don't have to think too hard as to what that looks like. The other thing is right beneath it, so it says by way of, and then you would put that information. Right beneath that, it's all blank. That would be where you could, if one existed, you could put a second mortgage, a HELOC. Like again, if it was an 80-10-10, that 10% would go there. But if it were a VA loan, a VA loan might have $1,000 total earnest money, or let's say it's even more. Let's say the purchase price is $1 million, which is not unheard of here in our market. It's $1 million. You might not put $1,000 earnest money, even if it's a VA loan. You might put $10,000 or even $20,000 if they have that. Whatever's negotiated in there, right? With all that being said, you know what you want to put in there is the return of the earnest money deposit. So that section by way of in the monetary portion of that, you're going to put in parentheses or by using the hyphen, which is the negative sign, the deposit. So if it's a $10,000 earnest money deposit, in that section you're going to put parentheses $10,000 so that it negates and backs out that amount of money. And then for the description underneath by way of, you're going to put something simple like buyer for use of at buyer's closing costs or at buyer's discretion. Something to that effect so that the buyer has the ability to either use it towards their closing costs if they want to, or to get it back as a refund at closing. And the reason you want to do that is it leaves it up to them to use in either circumstance. But if their lender, if the buyer's lender and they're using a VA loan, if the buyer's lender is paying for all of their closing costs, then they should be determining where it goes, right? They don't have any more closing costs to be paid, so it should come back to them. But you're putting them in control. But nonetheless, put what kind of loan it is. Be specific as to, does the deposit get returned back to them? Does it get used towards closing costs, or do they get to decide, which I always am a fan of letting them decide. So what are the pitfalls in the mortgage process? Which there are tremendous amount of potential pitfalls. Here's some of the ones that I easily could think of. Property not appraising, that happens all the time. I gave examples as to how you can try to avoid some of those kind of things, making sure that the property is in the condition acceptable to especially government type of loans. Cracked glass, holes in screens, wires that are not capped off and exposed, or other safety kind of issues. So get ahead of some of those things. In Hawaii, we have a lot of properties that are CPR. CPR stands for condo property regime. It's typically a single family home that's not attached in most cases to another property. So it looks like a single family home, but it really is part of an association or a condo. And in many cases, depending on where it is, it could be a cluster of 2 to 5 or 6 homes that share an easement or share, in this case, a driveway. If in fact it does, as agents, whether you're listing it or you're looking to write an offer on it, you got to get it. I see this come up so many times in escrow at the last minute, and agents are trying to put fires out. And the first question I ask is, why don't you jump on this before even writing an offer? Or if you're the listing agent, why didn't you address this before even taking the listing or while taking the listing? You need a driveway agreement. I would say that 95% of lenders today are going to ask for that. And what that driveway, the shared driveway agreement looks like is, if there are 4 properties that are sharing this driveway, who's responsible if the driveway is damaged or needs repair, or God forbid there's a pipe that's running through it that bursts or something crazy like that? Is it, because you can assume like, oh, there's 4 properties, so it's 25%, but is it? I mean, it's not always that simple. What if the driveway is more on one property than another property, and so that property, the guy who only has like 10% of that driveway on it might say, I should only pay 10%. Well, the other guy's going to go, no, it's 50-50 or whatever it is. So those shared driveway agreements are super important, and we have fiduciary responsibility. So if we're looking out for our client's best interest, that is something that you should be looking into ahead of time, so that when they close in the escrow, that they're not walking into a potential disaster. This one's a no-brainer. No smoke detectors, or smoke detectors that aren't wired properly, or you ever see, just shame on me, this is probably my house, but like a smoke detector with a battery that's missing because it just chirps in the middle of the night. By the way, why do smoke detectors only chirp in the middle of the night? I've never heard my smoke detector ever start chirping for a battery in the middle of the day. It's always in the middle of the night. Anyways, smoke detectors, no smoke detectors, or one that's not properly connected, or wires or batteries missing or whatever, is absolutely a potential red flag on VA. So if you're doing a showing, you see that, make sure that that's addressed and remedied prior to an appraiser going out there. Square footage not matching public record. This is one that comes up, especially in Hawaii, often, because we have older homes here, and some homes were built at a time where people didn't want to. I think it's inconvenient. Some people have the belief of, it's my property, I don't need to ask permission to do certain things, and yeah, do whatever you want to do. However, if you are buying a property, if you represent a buyer, or if you are the buyer, and the square footage, let's say that it's physically, actually, it is a 4-bedroom property, but on public record, it's a 3-bedroom. The problem that you're going to run up with if you're getting an appraisal is the appraiser is going to give you value for what's on public record, the 3-bedroom. They are not going to give you value for this extra room that the seller may have built. It is extremely important for you to know that, both on the listing side as well as on the buy side, that's a thing, because you're going to have to. That's a potential issue. Now, if it's an all-cash buyer, no problem. They can choose to purchase that. You still have to disclose that. If it's a buyer that absolutely wants the property, and even while it may not appraise, they're willing to come in with the difference, because I've seen this once before where on public record it was a 3-bedroom, 2-bath home, but actually it was a 5-bedroom, 3-bath home. They added on, like they doubled the square footage, added on an extra bathroom and 2 more bedrooms. It closed with no problem because it was like the biggest house in that neighborhood. But it's not easy, because the buyer still had financing, so the lender was only willing to finance what it would actually appraise for if it's public record, matching public record of a 3-bedroom, 2-bath home. So there's challenges, and you're not trying to solve every single problem, but you need to understand them and get ahead of them so that you can prepare yourself for escrow. Borrowing money or closing costs with basically gift funds. Gift funds could be a pitfall, because people don't realize is as of 2009, there was something that was instituted called the Patriot Act. The Patriot Act is a set of rules to combat terrorism and money kind of appearing out of nowhere. And if you have, even if it's mom or dad, so let's say that I'm buying my first home and mom is gifting me $50,000 to help with my closing cost or my down payment, whatever that might be. First thing is, you got to make sure that The gift funds, percentage-wise, is even allowed by the lender, because some lenders restrict the amount of gift funds that you can have for your own closing costs. Like, they want you to have certain contribution as a buyer along with the gift funds. But check with that first. Secondarily, you got to make sure that the person that's providing the gift, in this case, mom has to be okay with providing her entire, every single page, probably 2 months, maybe even 3 months worth of bank statements from the account in which she's giving me the funds from. And why is that? Because they have to do, lenders, banks, credit unions have to do that. It's part of the Patriot Act. They have to source all the funds. And you might think that that's not a big deal. Here's why it becomes a big deal. If mom has deposits that are in there that are all cash deposits or things like that, the bank is going to ask, where did this come from? I need proof where that came from. And I need a letter proving this, where this came from. Oh, you sold something on eBay? I need a proof that where that came. And it's going to be one of those kinds of things. They're literally going to go through it forensically to source all these different things. It's much more than just give me the bank statement that came from. So I say that in advance, because if you're dealing with a buyer who says, mom's going to give me some gift funds, work it out in advance that maybe it comes from an account that doesn't have much activity on it. Maybe it's an account that's a little bit dormant, or it's coming from the checking account, that's fine, but tell mom in advance, this is what we're going to need. We're going to need a gift funds letter. We're going to need a copy of the statements, and more than likely, you're going to have to explain all kinds of deposits in there. Another thing that comes up is mattress money. Some people will say, yeah, no, I have enough for closing costs. I have $20,000. And I go, great, what account is it in? Oh, it's literally, in my safe at home. That's not, no lender is going to take money from safe. They don't take cash, never, ever. So if you can buy a property all cash, but you can never have earnest money or down payment be cash. It has to come from an actual account that the lender can source. And that's also part of that Patriot Act as well. So money can't appear from thin air. So just know that if someone has a ton of money at home, which they intend, and that's literally, they have more money at home than, by the way, I know these, they have more money at home than they do in the account. Prepare them in advance and say, listen, you might want to deposit that money. That money has to be what we call seasoned, which is in an account for a certain amount of time. Has to be seasoned for typically 90 days on average to get that account like in order before they start going to escrow. So these are things that you should know in advance. Last minute credit. So if you're an agent, this is like one literally that I deal with so often with some of our agents here is, they're closing in a few days, and they'll say, oh, by the way, I gotta, I need a credit to show up on the closing statement, or we negotiated a credit for home inspection, or whatever the thing is. It doesn't matter what the credit is or what the reasoning is, but they're asking for credits and they intend on closing in a week. Well, if the loan rather has been underwritten already and approved, you absolutely are going to derail or possibly delay closing, because that lender is going to have to re-underwrite. And don't do that. Don't wait till the last minute. Get ahead of it. If it's something from J1, which is the home inspection, request to negotiate credits in advance and then immediately let the lender know. If you even think that a credit's coming through, let the lender know. Lock extensions. That's absolutely something that comes back to bite people all the time, is a lock extension. A lock extension could be because, we mentioned this before, maybe you have to have it reappraised. Maybe the appraisal is subject to. Maybe there's the last minute credits. All of those things, or any one of those things, could result in, I need to extend our lock because we will not close on time. And a lock extension is one of those conversations that makes everyone hate everyone. The buyer is upset with their agent, the agent's upset with the other agent, the listing agent's upset, the seller's upset with the listing agent, everyone's mad at each other. So you can avoid some of these things if you think a little bit ahead. Large credits, so we talked about last minute credits. Large credits could be a deal killer too. If you have a credit of $15,000, trust me when I say the lender's going to go, hold on a second. Why such a large credit? What do I need to know about? Is a roof caving in? What's happening? That's what they're looking at, because they're looking at it from their perspective of risk. And if the risk seems too high because of such a large credit, they're going to want to know what that credit is for. And then lastly, leasehold financing. It's very common here in Hawaii for leasehold. Leasehold financing is basically where you don't own the property indefinitely like you would a fee simple property. You own it for a certain duration of time. And once that lease runs out, then the property back. They don't buy it back for market value. They don't buy you out. You just give the property back. So the rule of thumb is most lenders can finance, I should say some lenders can finance leasehold, but you got to have some common sense with that as well. So if the leasehold, the lease remaining is 60 years, which most of those leases are long-term, which is fine. So let's say it's 60-year lease and you get a 30-year fixed loan, no problem, right? Not a big deal. That 30-year term is going to be finished prior to the lease expiring. But oftentimes I'll see agents ask and say, I have a lease that expires in 12 years and I want to get a 30-year fixed. How are you going to get a 30-year fix on a lease that expires in 12 years? So there's a buffer that most lenders want if they're even going to consider financing on a leasehold property, which is a 5 to 7 year buffer on that lease, meaning that they'll give you a loan that has a 5 to 7 year window of when that lease expires. So just something to keep in mind. But there are lenders that specialize in leasehold, and their terms are not Fannie Mae, Freddie Mac, not FHA or VA or anything like that, but they're very specific to that risk factor with leasehold. So foreclosure watch, we're in July. I'm recording this so people can watch in the future, but right now, July 2021, next month, there's some good indicators, some economic indicators that we can keep an eye out, which is the eviction and foreclosure moratorium is going to come to an end in August. A lot of economists and financial experts are looking at it as what's going to happen and how will that change our market in terms of foreclosures, short sales. Lis pendens, which is the process, the legal process by which a bank or lender begins the foreclosure, there haven't been lis pendens filed at all because there's that moratorium. So numbers matter, but you got to look at the whole scope. So when people look at like how many lis pendens is filed, what's the risk of foreclosure or short sale, they see nothing and they go, I literally heard agents say there's nothing, our economy must be super strong. Well, yes and no. I mean, yes, our economy is strong. It's still robust, especially in our market here in Hawaii. It's always, for the most part, pretty robust. We're always top in the nation for appreciation and sales price ratio and these kind of things. However, there's no lis pendens because there's that moratorium. So you can't. You got to use that information the right way. With that said, I don't know if I'm broadcasting to a lot of different channels, so I'm not sure if these areas fall into your area. Fortunately for our market here, which is Honolulu, it does not come up, but I always thought this was interesting is it still shows the US or the national for percent of delinquent loans and seriously delinquent, which is usually upwards of 90 or 20 days, and then loans that are backed by government loans, FHA loans, and so forth. So that's that. In kind of finishing things up, FAQ. So, and by the way, feel free, I'm getting at some comments, most of which are just comments, not questions. And thank you for participating and jumping in on that. But if you do have questions, feel free to add them to the chat, whichever channel you might be on, YouTube or Facebook. Couple of questions that I get asked all the time. Is it better to go with a local bank or lender than a mainland lender? When I practiced in the mainland, the lenders that had strong value in writing an offer, Chase or Bank of America, were good, but that's not necessarily the case here. Here in our market in Hawaii, we have varying degrees of value of property. We have leasehold versus fee simple. We have CPRs, which is again that condo property regime, which is unique here, with shared driveways and all kinds of things. So lenders, as a knee-jerk reaction, will always say, oh no, we can do it, we can finance anything. And they can, but God forbid you write a contract for your buyer to be competitive and you write it as a 30-day closing and it takes them 90 days to close or 60 days to close because you're using a mainland bank who has to keep extending because they don't understand how certain things are underwritten here. So can they do it? Yes. Is it a good idea? Probably not. Not on something that is urgent or time critical like a purchase. If you want to go with a mainland bank, use them for a refinance. If for some reason they have an unbelievable deal that a local bank or lender can't do, which is usually not the case, But yes, as a local real estate agent local to Hawaii, it is probably better for you to write an offer with a local lender or bank that people recognize here, because the seller and the listing agent want to have the confidence that they can close on time without a hitch, without extension. Can my client buy a piece of land using conventional loans, VA, FHA, USDA? Some of those loan programs are available for raw land. However, one thing to note, I get this all the time, is VA buying land or VA buying investment properties. FHA and VA are specifically VA is owner occupied. That's it. So you can have, I've heard of people saying, well, my property that I have in Texas is rented out, and I bought that using a VA loan. There's still a VA loan on there. That's and you can, because they PCS'd out. But you cannot use a VA loan to purchase with the intent not to occupy. So those loans are owner-occupied type of loans. USDA does have a land purchase program and that sort of thing, but FHA and VA are owner-occupied loans. Conventional has some programs some lenders do with certain amount down. I kind of alluded to this. Can my client buy an investment property using a VA loan? No, you cannot buy an investment property using a VA loan. However, you can turn your VA loan into an investment property so long as you either have occupied it for 12 months or you PCS'd out. What's a construction loan? Construction loan is the type of financing. Let's say that you have raw land, or let's say that you have a property that needs work to whatever extent. A construction loan, which I think I showed the stat, there wasn't many construction loans, maybe 10, I think that number was 10 or 14 or something like that in 2020. So on Oahu, not a ton of them, but a construction loan is whereby a bank comes in, gives you a loan to purchase the property, and then phases in a certain amount of money per phase. So it could be 1, 2, or 3 phases of amounts of money that that you would use to rehab, and they would check like the permits and the architecture and where you are in those phasing in of those of the rollout of the rehab. So that's what a construction loan is. And at the end of that, which typically is 1 to 2 years for the most part, after 2 years' time, it converts itself over to a 30-year fix. So it's kind of an all-in-one inclusive type of loan, but it is not easy to find, and the rates are not, the greatest, but you can still find them. What's a rehab loan? I kind of alluded to what that is. It's a loan that gives you enough money to do. What's a hard money or private loan? This is a loan that is for non-owner occupied primarily. It wasn't the case before, but some of the new laws have put in place that's what it's for now. And you find this a lot in investors who are buying properties to flip. So it's short-term money. It's money that they intend on having out there for maybe a year or less for the most part. Sometimes you see it for 2 years, but it's an investor purchasing a property with the intent to fix it up and flip it. By the way, the interest rates are typically very high, as well as the cost. What's a HELOC? A HELOC stands for Home Equity Line of Credit. It is typically a second mortgage or a line of credit that is attached as a lien onto your home. Could be your primary residence, it could be an investment property as well, but it is attached to the home. And typically people get it because it's a large, you can have a credit line of hundreds of thousands of dollars depending on the equity in the room that you have available to you. And what could you use it for? You could use it to purchase other properties as the actual cash down payment. You could purchase it to pay off debt. You can purchase it, or you can use it rather to rehab a property, whether it's the primary residence that lien might be attached to, or another one. Lots of great uses for it. What is shared appreciation? Shared appreciation is typically a process that you go through in buying a property that could be low income. It could be, and you find it in Hawaii a lot in certain areas, like Kapolei has a lot of it, where you might buy a property that is priced under market value. And for that, you have to qualify income-wise. And sometimes, again, it's like that bucket. You can't make too much, but you got to make enough. You have to occupy that property for a certain amount of time. Certain amount of time is different per project. So there's some shared appreciation projects that you have to occupy for 5 years, 7 years, 10 years, or even some that's indefinite. But when you go to sell, if you've waited that allotted amount of time, then you're good to go. You can sell it at normal market value. Whereas there are some that when you go to sell it, if it's within that time frame, of that shared appreciation, let's say that it's a 10-year shared appreciation and you're only in there for 3 years, then what happens is you have to sell it for someone who qualifies for how you qualify. They might have to be owner occupied, they might have to qualify income wise, and you have to sell it for an amount that the county tells you to sell it for, allows you to sell it for, not an amount that's market value. So as real estate agents, if you ever look on the MLS and you see a weird number where like you'll see a condo that goes for $500,000 and then you see something that sells for $472,911. It's like, what a weird number. Why are they coming up with that number? 9 out of 10 times, that's shared appreciation. And the reason why that number is what it is that's the maximum based on some calculation that the county provides the agent when they go to list it. That's the number that they're able to sell it for, because they're looking for someone who qualifies for shared appreciation to be the buyer. Can the seller dictate which lender the buyer uses? And I think the next question kind of coincides with this as well. The buyer wants to buy new construction and the builder will only give incentives if they use the builder's lender. Can they do that? Here's the answer to that. The answer is the buyer always has the right to choose which lender they want to go with. A seller cannot dictate what lender a buyer can use, but if you are going through new construction, or if the seller wants to give you incentives to get pre-approved with their lender, or to use their lender, that's your choice. So a new construction, this happens often. Maybe the builder will provide additional upgrades, or they might give you $10,000 in closing costs if you use their lender. That is still entirely up to you, but using your own lender would negate that incentive. So it's entirely up to you on how you want to use it. I would say that in my clients' experience using builders lenders hasn't been, customer service wise and time wise, hasn't been the greatest, but that is something that you should explore depending on the incentive. It's risk versus reward. So if you're getting a huge amount of incentive to use them, it might be worth going through that headache, but that's entirely up to you. What's the difference between an owner-occupied loan versus investment loan? I kind of alluded to that before. It's typically 1.5 points in cost, or sometimes even rate. So because of that higher risk factor, there needs to be more equity, or on a purchase, there needs to be a larger down payment. And the interest rate that you're going to qualify for is much higher than that if you plan on occupying the property, again, due entirely to risk. So there's a huge difference in that. Lastly, what is a short sale? A short sale is part of a distressed property. So it's when you cannot afford, or a buyer or homeowner can't afford to maintain or make those mortgage payments, and they default on the property. If they default and they do nothing at all, at some point they will be foreclosed upon by the lender. If they want to, a responsible or more responsible thing to do is to hire a real estate agent to negotiate a short sale. So the short sale basically is a process by which you're negotiating with the lender to sell the property short of what you actually owe. And this doesn't come about typically when the market is super robust and everything is selling without issue. It typically comes up when you owe more than the property is worth. And that could be because you're over leveraged, you borrowed too much, or if the market shifts and it pulls back a little bit and it depreciates or idles from where the normal. An example, let's say you owe $600,000 on a property, the value of the property is $500,000. You're behind on payments, you can't sell it, because if you sold it, you'd have to cut a check for $100,000, of which you may not have. What do? You contact a real estate agent who specializes in short sales to negotiate with your lender or lenders to sell the property short of what you actually owe on the property. So I will be teaching a class on short sales and distressed properties and foreclosures and so forth. So that will be coming up at some point in the future. Other than that, guys, thank you so much for tuning in. I wanted to make sure I provided. I hope I gave some value. This video will live in perpetuity on a bunch of different channels. If you have questions, you're welcome to contact me. You can reach me on my cell phone at 808-754-5800. You can always email me at chadshima@kw.com. And thanks for tuning in. Hope to hear from you soon. I look forward to next time. Thanks so much, guys. Take care.